Good morning, Michael. I'm so glad to see you again. This is Laura Fournier with Nations Lending, and today I'm with Michael, as we are every week, to talk about some fascinating mortgage and real estate topics. So how are you, Michael?
Great, Laura. How are you today?
I'm just fantastic. We're
Good,
meeting on
good.
a Wednesday instead of a Thursday. No, instead of a Tuesday. So
Yeah, it's all good. It's beautiful out there. I'm Michael Kurchanik with Macintosh Realtors. Really excited to talk about the buy down loan process. Now, when I talk to my clients, Laura, I tell them, I handle the sticks and bricks. Lender handles the numbers and the monies. But it's very important for me as a realtor to help guide my clients as buyers on the various types of loan that they might be exposed to. And then I need that information to present an offer to a seller, and I have to be able to articulate it. So I thought maybe today, Laura, we could talk about what does it mean to buy down a loan, and what does that entail?
yeah, and this is a feature on a loan product, and we literally have not been using this since the late 80s, early. So it's been a long time since we've even done a buy down. My first loan that I personally got in 1989 was an FHA 2-1 buy down. So
Okay. So hold on. So it's an FHA loan, so that's a government-backed loan, right?
yeah, it can be FHA and it can be conventional, but my first one was an FHA loan, my first loan that I ever personally got.
Sure. And you said the number's 2-1. What does a 2-1 mean?
2-1, 2 means we're going to buy down the actual note rate for 2 years. So for 2 years, you're going to have a lower payment. So it's going to be 2% for the first year, lower than your note rate, and 1% the second year, lower than the note rate. So we're going to show you an example in a minute.
Okay.
So I'm going to do a screen share. But so say rates are at 7% now, and everybody, the buyers are like, I never heard of such a high interest rate. Oh my God, I can't buy. That's just terrible. I can't buy. Rates are too high. I can't buy.
Yeah.
And we're probably hearing that. I'm hearing it. Are you hearing it from clients?
So I'll tell you where I hear it specifically, Laura. I hear it when I talk to potential sellers. Now, just stay with me here for a minute. So when I talk to a seller, whether it's over a cup of coffee, lunch, whatever, or I come over to the house, they're like, Michael, talk to us about selling the house. And we talk about what their current interest rate is. And they're like, Michael, I live in a house with a 3% interest rate. What am I going to do? Buy a house at a 7.5% interest rate? That doesn't make fiscal sense. And then that's when I tell them, I do the sticks and bricks, talk to your lender and see what options you have. And it would include, from what I'm hearing, a 2-1 buy down loan or an adjustable rate mortgage, but a buy down on a loan. So that's their conversation with their lender.
Yeah, because that's a really great point, because it's very difficult if you do have something in the threes or mid threes, upper threes, even 4. It's hard to give that up to take a 7, but there's a lot of people that need to move, have to move, whatever, job transfers,
Right.
sadly divorce, maybe the death of somebody, or maybe they're just ready to move up, and it's the time, so they're going to make a decision to do that. But this could possibly be a solution that would work for some people, especially for first-time home buyers, because I bought my first house using a buy down because it made me more comfortable with the payment when I was getting in. So let me do a screen share and we'll go through some of the elements of a buy down. Making sure, hold on, I can't see my screen. Okay, just want to make sure I was sharing the correct screen. So can you see where it says broad overview of a buy down?
Yes, I see it now.
Awesome. Very good. So a buy down is when we get funds, and all the funds must come from the seller. So with the change, and you can speak to this more than I can, with the change in the market, it's still a seller's market because there still is short inventory of houses, but the market's become a little bit softer, and a lot of sellers are at least open to giving some help to the buyer. So um, if the seller is willing to do that, we can use the funds from the seller contribution to actually buy down the interest rate on the loan. So if it was a 2-1 buy down and the note rate is 7%, the rate for the first year would be 5. The rate for the second year would be 6, and then the rate for years 3 through 30 would go to the 7, assuming they didn't refinance. So we use the funds from the seller to put into an account, a buy down escrow account, and that actually supplements the buyer's payment every month for those first 2 years. So the buyer gets the benefit of a lower payment, and it kind of graduates them slowly into that mortgage payment. So they don't have to have the shock of a higher payment right out of the gate. It kind of steps them into home ownership. And that's really the benefit of the buy down, is to help buyers get into home ownership and give them some time to adapt and, see how their finances are when they have a home payment. And it's funded by the seller. It has to be funded by the seller or like a builder if the seller is a builder. It cannot
Okay,
be funds coming from the buyer themselves.
okay, so if I'm selling a house and the buyer comes in with you on a buy down funding, the seller, I pay how much that gets held in escrow? How much do I pay to
So I'm going to give you
keep the
that.
buyer's interest rate down low?
I'm going to give you that example. So in this
Okay.
example, we have a $400,000 sales price. They're putting 5% down, so that's 20,000. The loan amount is 380, and the note rate is 7%, and we're doing that 2-1 buy down. So
Okay,
the principal and interest at the note rate of 7% is $2,528. The total the seller must contribute is $8,857.08, and we get this over here in the annual subsidy amount. This is just a mathematical calculation of the difference in the note rate between the buy down rate and the actual rate. And we have a little calculator that we use to get those numbers, or I can do it manually. Having been in the business for all these years, I remember manual calculations because that's how we used to do it. We didn't have all of this stuff.
well,
So
back then
this,
you had an abacus, I know, back
yes,
with the cave
I've been
drawings.
here since dinosaurs. So
Yeah, exactly.
the seller's subsidy represents 2.21% of the sales price, and that just is this figure, the 8,800 divided by the loan amount. The sales price.
Oh, okay.
So the maximum seller help that the seller can actually give is 3% of the sales price, because on a Fannie Mae 5% down loan, they could give up to 3%. So, and say the contract was written with the seller giving 3%, we would use 2.21% towards the actual buy down, and the rest would credit towards their closing costs.
Okay, so it's appealing because the market is shifting now. We're seeing an increase in inventory. Quick example, back in February this year, Frederick County, Maryland had barely 200 homes on the market, of which 110 were new home builds. And today there's almost 500 homes on the market, of which 120 or so are new home builds. So we're seeing inventory increasing. So what does that mean? Means buyers have more choices, which means we're seeing fewer, if any, multiple offers on homes. So having said all that, on in this example, if my client's selling out for $400,000, a buyer can come in with a full price offer,
Mm-hmm.
but ask for 3% seller help and closing costs, and then the seller would know that of the 3%, 2.21% will go towards the buyer's loan, which is a buy down loan, and then the balance would be towards additional closing costs,
Yes,
correct?
that's correct. That's correct. And it gives the seller the opportunity to offer an incentive. They could actually do this up front and share that information with the buyer and just say, we have our house on the market, with this offer, we're willing to give 3%. And it's kind of an attraction to the buyers to look at their house, and then they'll already kind of have the numbers, not the exact numbers because it may vary depending on loan product,
Sure.
but they could use it as a sales tool, which is what it was back like in the late 80s, early 90s. When I bought my first home, rates were above 10%. We were in double digits. So I had a 2-1 buy down, which was 9% the first year, 10% the second year, and 11% from years 3 through 30. So, but these funds are like literally sitting in an escrow account, and then it subsidizes the payment for the buyer every month when they send in their payment, because they're going to be sending in the lower payment, and then it gets subsidized because their real payment here is at 7% is 3,200,
Right.
but they are only going to be paying a total of 2,700 this first year out of their
So,
pocket. So it gives them that lower payment for the first 2 years so they can get used to being homeowners. You adjust your budget a little bit. You can still put money aside in savings for repairs and all that good stuff.
right. So the annual subsidy amount, that's held where again?
That's held in an escrow account. It would be similar to like their homeowners insurance escrow and their property tax escrow, but
Okay.
that particular loan file would have a buy down escrow account.
Okay, and you mentioned earlier, the buyer at any time after settlement can choose to refinance.
Yeah, so if rates come down next year, say they buy this year and they're at that 7%, but rates maybe they go to 5.5 next year.
Yeah,
And there's some indication that, that may happen depending on where things go with inflation.
right.
All the remaining funds that are in this subsidy escrow account would go towards their refinance. They're not going to lose that money. They would just credit towards their principal. So it would reduce their principal that they have to pay off. So it's not money lost or spent. It would just credit towards their refinance transaction.
Okay, so Laura, then let me ask you, some of my sellers will ask, well, geez, Michael, will this slow down the home selling process? Because we have to have an escrow account, the subsidy, looks like there might be more paperwork. Will this delay us from going to settlement, or is it going to be processed just like any other loan?
It's going to be processed just like any other loan. Probably another sheet of paper just so that we're showing them how the money works, how the figures get played out. But no, it's not going to take any longer at all. We're set up to do these, and it will go just as smoothly as any regular loan. It's really just an added little feature on the loan. So
Right,
you can attach this buy down to a Fannie Mae or a Freddie Mac loan. You
okay,
can use it on FHA loan, a VA loan, and a USDA loan. But just FHA, VA, and USDA, they don't do the 3-2-1 buy down. They only do the 2-1 buy down. So 2 years where it's bought down. Fannie and Freddie will allow 3 years of it being bought down, but that gets considerably more expensive. And I probably doing the calculations, working with the realtor, it might be too much money for the seller to give.
Yeah,
Doing 3 years. So I think the 2-1 is going to be more prevalent than the 3-year.
okay, excellent.
So, and like I said, the money must come from the seller's side. It cannot be funded from the buyer's side, which actually makes sense because, the buyer isn't going to put their own money aside. They would just make the higher payment.
Okay.
The interest rate is actually just the note rate, the real interest rate. The buyer has to qualify at the interest rate, that note rate. They don't get to qualify on the lower payment. So we're
Oh, right. Oh,
so
okay,
we're
okay.
qualifying them in this example at 7%.
Right,
They have to
right,
qualify at the 7. They're not qualifying at the 5 or the 6. They have to qualify at the 7 for the loan.
right, right. On
So
the
that's
2-1 buy down, that's the third year, right?
yes. So it's very important that we're not using this to qualify people at higher than they can really afford.
Okay,
It's
understood.
really just to help them graduate into the house payment and give them that 2-year time frame to get comfortable, and then they have the full payment.
Yep.
So like I said, it can be conventional, it's for primary residences, can be used, it's only used with the standard 30-year fixed. We do manual underwrites for FHA, VA, and USDA, but they have a maximum of 45% debt to income ratio, where if it's a runs through automated underwriting, we can go to 50%. Minimum credit score is 580, and that's for a FHA or VA loan. And like I said, the buyer has to be qualified at the permanent interest rate, the
Mhm.
full index rate. Most of this stuff is just our internal appraisers have to put it in the appraisal notes that there's a buy down is being used. And we disclose everything. Just some ineligible, you can't have the lender or the borrower pay for the buy down funds. We don't do them on renovation loans. We don't do them on jumbo loans or any of our non-conforming like portfolio product, and not on extended rate locks.
You
That's usually
mentioned
for new builds.
you mentioned in the previous slide, Laura, the appraisal, that it has to be in the appraisal report. It's interesting because our topic next week will be about all things appraisals and appraisers. So let me ask you on this point, Laura. It's simply noted, but it doesn't affect the value of the home, correct?
No, not at all. They actually note in the appraisals now the amount of seller help.
Oh, right,
So it's just going to go in that same section. So
right. No
it's
problem. No problem. I
they're
just wanted
really
to clarify
already
for
doing it. It's just
viewers.
a little bit different verbiage. Instead of
Yeah,
seller subsidy, it might say seller subsidy for buy down or something. I don't
yeah,
know the exact words they're going to use, but it's really already there in
yeah.
every appraisal report. It just will have a couple little extra clarifications on there.
Right, because appraisers do track, how many of their reports are based on conventional FHA, VA, stuff like that, cash
Mhm.
offers, 1031 exchanges, stuff like that. So it's interesting to see. It's been a while since I've seen a buy down. So, but I do understand the appeal of this in this market where interest rates are mid sevens right now. Which are already adjusted for the Fed hiking their interest rates later today, another 75 basis points. We'll see another increase over the next 2 months because it looks like in January, the Fed will increase the interest rates that they charge overnight banks, maybe another 50 basis points or so. And that's why I think it's good for viewers to understand that they could ask their lender, hey, what about a buy down loan? Is that something that I can qualify for?
Yeah, and they're definitely It's just a feature we add. So if they're qualifying for their loan anyways, they can just add this, but they want to do it at the time of, definitely the lender and the agent have to discuss this because they have to put it in the offer that they want that help from the seller. But I think
Yeah.
it's good for all agents, whether they're listing agents or buyer's agents, or they do both, to know about this because they're going to start hearing about it more and more. It's been in the news. I've been hearing it myself. And it has been a long time since we've offered kind of an incentive to help the buyers just feel more comfortable getting into the market. And
Yeah.
the benefit is that if rates do come down, those funds that got left over in that buy down escrow account get credited back to them. They're not losing them. They'll just be used towards the refinance, which is great news because that can absorb, some of the costs associated with refinancing. But definitely if there's the opportunity to refinance, they want to take advantage of that and get into that lower interest rate, hopefully before the buy down, ends. So, and I think it's, a good incentive for the seller rather than reducing maybe their sales price. If their house doesn't sell super quickly, offer a little incentive to attract the buyers.
Yeah, I think that's great. Now, what if a buyer wanted to learn more about this information? Where can they go? Maybe some resources.
I'm sure it's on Google.
Yeah, yeah,
Not
sure.
that I want to send anybody just to any random old place. They can call you, they can call me. They definitely want to get a professional and
Yeah,
get examples. That's what I always do with my buyers is give them examples. I use a powerful tool called Mortgage Coach, and that actually shows them the numbers and compares different loan products. So,
yeah,
for sure you want to take advantage of consulting your professional.
yeah, exactly. And if they call me Laura, I'll be like, I know about this much. So talk to your lender. Let's bring our lender in. Let's bring Laura in, and she can help us out, and she can explain everything. Because, like I said, I don't get into their financials, but I do need to be aware of what a 2-1 buy down is. Because if I get an offer for, I'm representing a seller, I want to be able to say this is why they're asking for this amount of this percentage in seller contribution because they have this buy down loan. I want to be able to tell them, what that means in broad terms, and then call the lender to confirm, that
Mhm.
it's a 2-1 buy down. Yep.
And if anybody wants more information, they can just text the word buy down to my cell phone right there,
There you go.
301-674-7716. And I can send you some information on buy downs, and we can even talk and go through some examples. But I think it's an excellent way to get into the housing market, get comfortable with that payment. Hopefully, your payment isn't that much more than you're paying for rent because rents were up on average in 2021 17%, and in 2022 up another 6%.
Yep.
So rents have really been escalating more quickly than any time since they've been recording that. And so hopefully your payment for your mortgage isn't that much higher, if maybe none at all. I've had quite a few clients that have bought even at these higher rates, which are really only historically average.
Right, right,
Yeah,
right.
we're really in historic average
Yeah,
interest rates.
yeah,
So it's still a great time to buy and become a homeowner. Every time you make that payment, little bits going towards your equity. And in a lot of areas, most areas across the country, they're still looking at some price appreciation, maybe only 2-3%, but that's still price appreciation in most areas.
yeah. That's great, Laura. Thank you for this information. This is great. It's another tool in your toolbox for you as their lender, Laura, but also for buyers. And I think it's great for agents who are watching this video and sellers so that they can understand that this could be something that would be presented to them as sellers and their agents. And they can certainly get a lot from this video today. So thank you, Laura, for that.
Absolutely. And thank you for all those great questions. I think it was very helpful. And I love sharing with everybody. If I can be helpful at all, just give me a call. And we will be back next week to talk about appraisals, which are
That's right.
super important.
Until then, everybody have a great week.
Great. Take care. Be prosperous.